So thanks again so much to everybody for joining us today. My name's Agnes and I am the marketing manager at TDI Sustainability. And today I'm joined with Ashton Carter, who is the CEO of TDI, and also with Evelyn Verin from Denny Ellison. So we're really, really pleased to be talking today about ESG for buy-side equity research. And there'll be opportunities for question and answers as we go on through the session. So please do feel free to drop your questions in the chat, and I'll make sure that we follow up with those as much as we can. A reminder that today's webinar is being recorded so that it can be used and shared again in the future. We will produce a link for that within the next week or so on the TDI social media channels. We've got LinkedIn, Instagram and YouTube, and there'll be a full transcription available on the TDI website as well for accessibility purposes. So keep an eye out on that. We'll be talking for about half an hour today, and then with a bit of time extra for question and answers. And before we get started properly, I'd really love to just ask the panelists to introduce themselves so we can hear a bit more about their background and their expertise. So maybe Evelyn, could you start us off just letting us know a little bit about Denny Ellison and your work with that?
Yes, sure. Well, thank you very much for inviting me. So we are an independent research and training provider. We're based in London and the company was founded in 2010. We specialize in equity research and we are a team of 10 experienced analysts. Each with more than 15 years of experience on average. We all worked at leading investment banks and asset management firms. In our training program, we cover technical skills such as financial analysis, modeling and valuation, how to build a strong investment case, and how to write impactful equity research reports. We also cover soft skills such as communication and presentation skills. So I think that the program is really a great way to equip research analysts with a strong baseline of technical skills and upscale the research produced in the investment industry.
And Ashton, thanks so much, Evelyn. And Ashton, would you like to just introduce your work with TDI?
Great, yeah. So TDI Sustainability, we've been around for about 10 years now, and we are a purpose-driven sustainability consulting firm with expertise in ESG risk assessments and due diligence, and we work in multiple sectors and across the value chains with the investment and asset management sector, of course, but also with the corporates along the value chain, right from the Fortune 100 companies, large companies, down to SMEs, and in different continents in the world, and really working from mine to manufacturer, from farm to pharmacy, and understanding the relationships between the companies and where they are most exposed regarding ESG concerns and all the mitigating actions that can be taken to address those ESG risks. And so we're very pleased to be and having worked with Denny Ellison for a couple of years now to bring together this fundamental research and expertise that Denny Ellison has and our ESG competence as well, which we feel is a very good package to enable the analysts in asset managers and the buy side to face the kind of fast changing world of investment.
That's great. Thank you. That's really helpful context. And just to sort of reiterate the background of the webinar and the purpose of getting together today, we've been putting in context to the fact that over recent years, asset managers have been under growing pressure from their clients to integrate ESG into their investment process. And it would be just good to hear a little bit more about why you think that is. Maybe Evelyn, we could start with you.
Yeah, I mean, the initial driver of ESG integration really came from the clients of investment funds. There was a growing awareness and interest in ESG issues among investors. And they also realized that their investments could really make a difference. So together with that, they demanded for greater transparency on how their money was invested. But this demand has led to really an outperformance of ESG funds before and during the COVID pandemic specifically. But in the last 2 years, ESG funds have gone through a notable correction, given several allegations on greenwashing specifically. So as a response, we have seen quite a clear acceleration of the regulations around ESG performance for companies. But the drivers, I would say, has now evolved, and we're seeing a greater recognition among asset managers that ESG factors can really affect risk and returns of their investments.
It's really helpful, thank you. And Ashton, from the TDI ESG perspective, it would be good just to hear how you feel the landscape's been shifting over recent years.
Yeah, and of course, I mentioned in my opening remarks that TDI is a purpose-driven consultancy. So, you know, our fundamental belief is that the business sector is and can be even more so a driver for sustainable development. But what I think is kind of more fundamental at the moment is that the landscape just over the last couple of years and accelerating from a decade ago, the regulatory landscape has really accelerated in terms of the ESG mandates that it's placing on asset managers and the corpus in which they invest. And these regulations have multiplied in effort to combat greenwashing and to standardize best practices. And they really are becoming very sticky in terms of their durability. And so, you know, we've done a recent analysis of the EU, the so-called Brussels effect, meaning that the EU is becoming the kind of a standard bearer for ESG regulations. And there are many kind of overlapping regulations which can be very confusing, whether that's the Critical Raw Materials Act, the Sustainability Reporting Directive, the Due Diligence Directive, the Packaging and Waste Directive, the Battery Regulation, and so on. And so asset managers and businesses are being kind of forced to engage and prove their credentials. And this can be a huge burden. Both kind of logistically, but also just to kind of navigate these different regulations. And I think another thing to bear in mind that these regulations now are not just about due diligence. And of course, due diligence is something that asset managers understand well, but they also have implications for the movement of goods as well. So the regulations have been shifting in the US and in the EU to say that in some supply chains, if there is a possibility that there are goods moving across borders that don't meet the expectations of certain jurisdictions, that they will be warehoused. So these are sort of things that asset managers now need to sort of better understand about their kind of portfolio companies, and not only the regulations placed on them, but also the regulations that have implications for their investee companies as well. So I think we're shifting really from the idea of ESG being something that is a nice to have and part of the ethical values of a company to something which is becoming increasingly mandatory and therefore has a compliance risk attached to it.
Yeah, that's really helpful. Thank you. Would you say there's any evidence that ESG impacts the financial performance of companies and their share price? Is that something that you're seeing more and more of?
I mean, from our side, there is really an increasing number of studies on this subject. But unfortunately, there is no clear consensus. So, and that's really due to the different methodologies that are used, and also the lack of track record, really, because all this is quite new over the last few years. But when looking at ESG and share prices specifically, an interesting finding is on the impact of ESG-related public issues or bad press on share prices. And if a material ESG issue has been widely covered by the press, then the market reaction can be really quite material. And typically negative news also gets more reaction from the market than positive news. So this is independent of whether the ESG news has actually got a financial impact on the company. So we're really talking here more about market sentiment impacting the share price. On the impact of ESG on the financial performance of companies and based on the limited track record, I think the only conclusive finding is that in general, companies that have stronger fundamentals, so that is a stronger balance sheet and higher profitability, are more able to spend on ESG and would rank better. But there is no empirical evidence of the opposite. There is also a general acceptance that if a company engages in ESG initiatives, it inherently has stronger risk management policies and is perhaps more innovative, which itself bodes well for stronger, financial performance.
That's interesting. And Ashton, how do you feel about that? Anything you'd like
to
add?
I think Evelyn has it right in that. Well, first of all, that the how to link ESG performance to financial performance has been evasive in terms of coming to a common methodology and understanding of it. Also, totally right that if a company is good at managing risk generally, and the ESG is on their radar, then the fundamental practices that they have can equip them well for doing that. I think there are some exceptions to kind of financial performance, especially when it comes to the natural resource companies, where they have to work upstream in an environment where working with local governments and communities is extremely important, especially if that has a possibility to interrupt cash flow. But generally, I think, yes, it's the science is out a little bit, and we've got to kind of help asset managers really understand what those risks are, how to incorporate them alongside other fundamental risks.
Am I right in thinking that TDI has a tool that helps with that, as the ESG evaluation methodology tool? Is that partly equipped to support companies with getting some sense of that?
Yeah, so TDI and Ellison developed a tool, and we published a paper a year ago now called Sin Stocks, and there we looked exactly what Evelyn was talking about. What is the impact of adverse news over the last 10 years, and what does that mean for the valuation and implications of then for the investment strategy alongside that? So yes, we again have combined the two organizations' core skills in data analysis on ESG, and also then the valuation methodology to come up with a what we believe is a more kind of robust way to looking at valuations and share price. Great.
I think that's available to download online, so I'll drop a link to that in our social media over the next coming weeks so people can find that easily. So how have asset managers been integrating ESG into their investment process? Maybe Evelyn, you could help us with that one a little bit.
Yeah, I mean, from what we have seen, ESG integration is done quite differently by each asset manager. So the first decision that they tend to make is whether they want to engage in the highest degree of commitment in ESG, which is called impact investing. This is when the fund will accept lower risk-adjusted return, prioritize the positive impact on the environment or sustainable goals, for example. The level of commitment below that would be sustainable investing, and then the one again below that would be responsible investing, which I think the latter one is probably the most common one. So when it comes to responsible investment, we get to have quite a broad spectrum of implementations. Some asset managers will exclude some sectors from their investment universe. Others will integrate ESG into their fundamental, forecasts and even valuation. And they may also create their own internal ESG scoring on the companies that they cover, rather than rely on external ESG providers. And then finally, there are some asset managers who simply view ESG as another area just to widen the information set to make investment decisions. So there is quite a broad spectrum here. But I think TDI and Daniel Ellison, we have worked with asset managers to really support them for all these different strategies and even the combination of those strategies. So our job is really to develop a fit for purpose training program to match the client's approaches and different approaches.
That's really helpful, thank you. And maybe Ashton, you could start by just answering the question, what are the challenges that equity research analysts are facing when they're integrating ESG into their research?
Yes, absolutely. And, I think one of the things that we've found is that perhaps one of the core issues is the one about familiarity. We've been working with corporates on ESG, or I have for 20, 30 years, and this language is kind of understood by them, but it's a fairly new and immature world for many of the asset managers, but one which is moving very fast. and it can be very confusing. So I think one of the first things is, how can we, well, the biggest challenge is, how is this relevant for the asset managers, and how do they implement it, and what are the implications of these ESG issues in their portfolios and valuations? And I think one part of that is trying to understand the difference between a adverse news event, a particular impact on the ground, and then bringing them back to what is that in terms of the actual upside, downside risk for the investee company, for the portfolio companies. And that takes more than just a data point. That takes context. You need to contextualize some of these events in your portfolio and understand what that kind of really means or you're at risk then of taking a misstep in terms of your decisions. And I think that's what Denny Hellerson and TDI can do together, is again combining the context of these ESG risks, getting the right data points, and then understanding how that fits into the valuations of the portfolio and what to do about it.
That's helpful, thank you. Evelyn, is there anything you'd like to add to that?
Yeah, I mean, I would definitely echo, Ashton. It is a totally new kind of like vocabulary set for fundamental equity research when it comes to ESG. I think what we have seen with the current client that we are servicing on the training side is the difficulty to quantify some of those ESG factors in terms of how material is it to financial forecast, to valuation, or to the equity story itself. And materiality is quite important, and that's going to base their investment decision and investment recommendations. So definitely being on top of understanding the vocabulary, but also being on top of the latest regulation is really, really important. And the last point I think is quite crucial for equity research analysts: how to cater the analysis for each of the sectors. The ESG issues are not the same for consumer, industrials, pharma, or the oil and gas sector. For some sectors, ESG is really, a major risk, where companies have to diversify their product offering and change their whole, business, positioning. Whilst for others, it is actually an opportunity, and it's a driver of growth. So differentiating between sectors is really important, and we can't really say one ESG issue is the same for all the different sectors, because there will always be differences.
Yeah, that's interesting. So you need to have a tailored approach, very, very much focused on that. So you've both together for a couple of years now been pooling your expertise to launch a training program on ESG integration, specifically designed for equity research analysts and portfolio managers. And I hear the feedback from large asset management firms has been very positive so far. So that's really great. Congratulations. And be interesting to hear how the training has been addressing some of those issues around ESG for the investment community, and how you've been managing to tailor, like you've been saying, tailor the sector issues and some of the other things that have been discussed to provide a training that's going to be really comprehensive. Ashton, maybe you could just tell us a little bit more about that program.
Yes, so maybe kind of some of the principles that we use going into the design of the program. I think I mentioned before that, that at TDI Sustainability, we've been working on kind of ESG risks for over 10 years now. And that kind of depth of knowledge is really important in the contextualization of the risks that we bring to this. But at the same time, we've got to make that accessible and practical. So it's sort of the simplicity on the other side of complexity that we bring to this. So in terms of the training package and how we present those risks, we can still do that in the language of the asset managers, of the analysts, but behind that is very much a kind of data-driven model, which has been developed over the last 5 or 6 years. So that's kind of one thing, that it's, be assured that we have the depth of the knowledge about this ESG risk, but the way that we present it is a way that is kind of very practical, pragmatic, and simple. Another thing, and Evelyn might have mentioned this, is that we don't preach a certain way to integrate and quantify ESG into the investment decisions. That, of course, is the domain of the asset managers themselves. So we're very thoughtful about how we can ensure that our training fits into the investment thesis and processes of our clients. Another one is that we decided not to just do a generic or even a general approach to ESG and risk, but that we would look sector by sector. So we have assembled about kind of 10 different sectors, and we do a deep dive into what are the specific ESG issues for those specific sectors and what are the mitigation actions and mechanisms that can be used for those portfolios. Another one we thought as well in terms of our approach to clients, and both Denny Ellison and TDI are of the same mind here, that this isn't just a one-off engagement. We're in this for the long haul. And so we offer kind of a long-term helpline, if you like, and we offer continuous support and updates throughout the year that we engage to make sure that our clients are appraised of the kind of fast-shifting ESG landscape. And that, of course, is specifically the case for regulations, which are evolving very fast at the moment. So I think those are some of the key principles that we use, which we hope are going to set us apart in enabling asset managers to integrate ESG into their systems.
That's really great, thank you. And Evelyn, I don't know if you've got anything to add to that.
Yes, I mean, I think what really differentiates our training program is that it's a holistic solution to equity research departments. You know, as Ashton said, the program is delivered live rather than being an online download, and it's company-wide. So we really look at where all the analysts and where the portfolio managers are currently standing on ESG, and we work with them over the long run to understand the ESG regulations, why it's important, how to integrate those, and also accompany them over the longer run on that journey. As I mentioned, and I think that's really what differentiates us from the other ESG training program out there, is that because ESG issues and opportunities are sector specific, we mirror sell-side research structure by covering ESG integration for 10 different sectors. And I think we're the only one to do that. And then the last point I wanted to highlight is that our trainers are fundamental equity research analysts themselves. So we understand the financial market, we understand the fiduciary duty of asset managers who are entrusted with investors with their money. We understand the risk-return payoff that they constantly need to assess. And when it comes to ESG, we understand the need to translate some particular issues into useful inputs that really inform the investment decision. And then the last point I wanted to highlight is, we are really trying to make this program very practical. So for each of the sectors, we actually take 3 or 4 of the major companies within a sector, and we take them as example on how to integrate ESG, how they perform on the ESG, and how to assess them and integrate ESG into the forecast. So I think those will be the main points I would highlight.
That's really helpful, thank you. I wonder, we've got just a few minutes left of the speaking time before question and answers, so it would be really great to hear any questions that you might have. If you want to put them in the chat now, is probably a good moment. But in the meantime, maybe we could just close off by asking, really, is there anything kind of upcoming on the horizon that around this topic, just generally, that our audience might want to be thinking about and have kind of in their mind to be looking out for? And maybe Ashton, you could just give us a start with that one.
Gosh, well, I sort of come back to the regulations, really, which are, as we both Evelyn and I have mentioned, are moving apace. Those for the asset managers themselves, such as the green taxonomy, which is still kind of working it through different kind of consultations in EU and in waiting to see what's going to happen in the UK. But increasingly, I think it's looking at the those regulations which are going to affect and the sentiment of those regulations, which are going to affect the portfolio companies as well. So, one service that we offer is sending a newsletter every month to do an update on regulations and which sectors and commodities and that they affect. So I think just that kind of wave, that kind of tsunami of regulations, which is landing on our kind of corporate shores, is something to keep an eye on, definitely.
That's helpful, thank you. And Evelyn?
I think for us, and thinking of the equity research analyst, the next catalyst will probably be the EU carbon entry tax, also known as the carbon border adjustment mechanism. This is going to come into effect on the 1st of January 26. And I think it will have really a material impact on the cost of all European companies importing goods in Europe. They will need to buy carbon credits with the emission implied in the amount imported. And this can have a material impact on the cost structure of the companies, and there will likely be winners and losers at that time. So I think this is really something to watch out for equity research analysts.
Sounds like the time to prepare for that is now, well in advance. That's really helpful, thank you. So I can't see any questions coming in. I don't know whether anyone has anything they'd like to add. Please feel free to do so if you'd like to, but otherwise I think we can probably say thank you so much. And just to reiterate that the recording for the webinar will be available within the coming days on the TDI website and also across social media. And I'll pop that link to the SynStocks piece that we talked about earlier as we do that, just so that people can find it if they need to. But otherwise, I think probably we haven't got any questions. So I think that's probably a good moment just to say thank you so much for your time, both of you. It's been really helpful to hear a bit more about it in depth. And obviously, if anybody has any questions after the webinar, we're available to reach out to on LinkedIn and on our websites at Denny Ellison and tdisustainability.com. So please feel free to get in touch. The TDI email for anyone who needs it is info@tdisustainability.com. And we're here to answer questions and help with anything that you might have heard about that you've got further ideas around or you'd like to discuss. And obviously the training is available to discuss further for companies who'd like to get some really in-depth knowledge around the topic moving forward.